This is Bob Baur, Chief Global Economist, Principal Global Investors, with some comments on the U.S. election and economic and market outlook. Well, the U.S. election was last Tuesday, and if you want to know what happened, the answer is, well, really not much. Prior to the election, the Republicans had control of both houses of Congress. Now it's going to be split. It looks like the Republicans now have a couple of more representatives in the Senate, so they have a little bit stronger majority. The Democrats have now a slim majority in the House of Representatives, so it'll be a split government. Now, what does this mean impact for the economy? Probably not too much. The Trump administration has focused on appointing conservative judges, on deregulating the economy and not putting on new expensive regulations, and they've had a lot of trade issues, and I think all three of those are going to continue. The administration has enough power to keep going in all three of those. Well, the oil market is one of the key prices around the world, and I think a few months ago oil prices spiked in part because of a kind of a unique circumstances. Venezuelan oil output continued to decline, and Iranian oil output was covered by sanctions. So the supply was restricted somewhat. In the meantime, Saudi Arabia increased its output, and the U.S. now is a huge producer of oil, now larger than both Russia and Saudi Arabia. So there's plenty of oil out there. In fact, in the Permian Basin in Texas, where they're producing oil out of shale rock, the price has actually been quite a bit lower because they're producing so much they don't have enough pipelines to get it out. So looking ahead, I think the price of oil will probably stay at this level. I don't see much reason for it to collapse, nor do I see any particular reason for it to spike much higher than it has been. As we look ahead for the rest of this year and into 2019, I think the key issue is going to be kind of a dichotomy between a very strong real economy, not only in the U.S., but it's pretty solid around the world, and yet financial markets that are going to struggle. You see, for many years, there's been a huge amount of liquidity produced or pushed into the world economy by central banks all around the world during and after the global financial crisis. But now that liquidity is being withdrawn as monetary policy is tightened and interest rates are starting to rise. I think this is going to mean financial markets are going to struggle. We look in the U.S., while we think there'll be a nice rally through the end of the year, a typical Santa Claus rally, we would guess that sometime next year this withdrawal of liquidity is going to be a real problem for stock markets. Interest rates, we think, will rise right along with stocks through the end of the year, but if we see 10-year Treasury yields get to the 3.5% range, I think that'll be too much for the financial markets to handle. So we look for the potential for a bear market, a significant downdraft in U.S. stocks next year. However, because the U.S. stock market has so outperformed the rest of the world in 2018 and really before, we wouldn't be surprised that U.S. stocks will underperform other markets next year. That doesn't mean that they'll be positive for the year, but emerging markets in Europe just might lose a little less than the United States. What that means then is that there'll be some flows out from the United States, so it could be that the dollar will likely weaken somewhat next year. Well, as I pointed out just a moment ago, if we do get a downdraft in U.S. stocks, it could be that there'll be outflows from the United States. But the question then becomes, where do those outflows from the U.S. go? Well, they may not necessarily go into emerging market debt and equities, because I think they'll be pressured along with U.S. stocks. However, they may just be not pressured quite as much. So we'll see U.S. stocks, for example, underperform. Probably the outperforming assets are going to be safe havens of some sort, whether they're government bonds in the US, in the Eurozone, or in Japan. So there may be fund flows, but not necessarily into emerging markets. However, if there are going to be flows into emerging markets, I really happen to like India on a long-term basis, and it could be that some of those flows may continue to go into India.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.